One of the things that's inevitable in our society is recessions. Recessions usually equate to bad markets. It doesn't take a recession to have a bad market, but they're part of investing. Investments don't go up all the time. What if we told you wealthy families looked at market declines differently, maybe than most families? I think there's some value in that. So if you look at some of the more recent market declines we had, the big one was the 08-09 recession, which was pretty problematic. And there were a lot of mistakes you could have. Prior to that, there was the 2000, 2001, 2002 3-year blood-drawing,
that was
drop a day, painful economy and market.
3 years is a long time.
3 years was a brutally long time, and I think people forgot about it. So what do you do if we experience a situation like that? There's a lot of things you can do. One of the things we say is you always prepare for the next recession at the start of the last recession, and you position your portfolio accordingly. Most of the clients who have built wealth are more interested in maintaining wealth at a reasonable growth rate rather than trying to compound their money, doubling it every year.
Yeah, so investing is really all time frame, and the shorter your time frame, either to retirement or in retirement, you should play it closer to the vest and plan for the next downturn, not when it happens, try to react to it.
So as advisors who help people through 2000, 2001, 2002, and the Great Recession and COVID and everything else, there are certain strategies that you can employ that will actually benefit you if and when we go through these again. So again, most families think that market drops are about one thing, and that's their portfolio, but the real damage occurs in hidden ways. So there's something called sequence of return risk. Sam, why don't you talk about sequence of return risk and how that affects you, especially if near retirement?
So sequence of return risk is the risk when you start drawing on your portfolio at typically retirement, how negative returns, especially early, in some cases cause you to run out of money. As your portfolio is growing, it's not, the magnitude isn't as great. Think about it. You have this $2 million portfolio at retirement, and now you're going to start drawing income off of it, and you want to take 4 or 5% out, and the markets go down to 25%. You don't have $2 million anymore, so the percent you're taking out is a lot higher. If exasperated over multiple years, it can have a significant impact on your retirement outcome. I define it in another way. What if you retire at a bad time? Meaning that you retired right before we have economic disruption. How's that going to look if that happens? How are you going to get through that? You plan for that ahead of time, not after it already happens or you're in the midst of it.
Right. No, planning by definition is doing something today in preparation for something going wrong later. And it may not go wrong. You may not have sequence of return risk. But if you do, right, the consequence can be pretty extreme, and that's forever is a very, very long time. Another potential outcome is missed tax loss harvesting opportunities, not selling things and rebuying them for tax loss harvesting. And then the other is just panic decisions. People pulling the trigger and saying, get me out. And we saw that a lot in 2008 and 2009.
Yeah, that's a fair point, because what happens during market downturns, we tend to turn to the media as to what's going to happen next. They're trying to get you back to come back tomorrow and watch or listen. And typically they'll tell you the world's going to come to an end or something similar. And that can really engage our emotions, especially if we go back to a day after day and the message is the same. So if we don't have confidence that our portfolio is going to work, we're susceptible to that in bigger ways.
So confident decisions we talk about them all the time. So what do the wealthy do? They have protection protocols that hopefully shield their wealth. It captures tax opportunities and positions them for recovery. So your advisor just saying, stay the course, stay the course, stay the course. You know what? That may not be enough. That might not be a strategy. It might be hope. Hope generally isn't a good planning strategy.
This video is for educational purposes only. Always consult qualified professionals before making any legal, tax, or investment decisions.
So from a high level, let's talk about what happened in times like 2008 and 2009. What we saw were, I think, two ends of the spectrum. We had, I'll call them, for lack of a better term, smarter clients. The smarter clients called and said, hey, Paul, you always say when the markets go down a lot, what should we do? Should we rebalance our portfolio? Should we add more? Should we stay the course in terms of not adding more money to stocks? And everybody's different. We also had clients that said, get me out. And I remember in March of 2009, having to go to a conference and I was at the airport. It had snowed. I got snowed in. I couldn't get out. I was stuck in a hotel for the day. And I just kept getting messages from my staff. Call Jim, call Joe, call Lucy, call Sally. And people said, just get me out. Usually a harbinger for somewhere.
That was pretty much the low, right?
And it was the Friday before the Monday low. And again, different people had different experiences. Some people took a decade or more to get back, and some people recovered relatively quickly.
So let's understand that if, in fact, one gets out during those perceived tough times, the other part of the strategy you have to get right is when do you get back in? And if you wait till you feel warm and fuzzy again, you're going to buy in at far higher prices than what you got out at, which defeats the whole purpose, right? Mm-hmm. So you feel better, but it's not good to your portfolio.
Let's talk about what can you do. So every market, we'll call it significant market decline, created a couple things. One is tax loss harvesting. And we think tax loss harvesting, which is a form of tax planning, can save you 1% or more annually if done properly. And we have specific strategies and ways to do that.
And those opportunities exist, and people, I think, miss them. So a couple years ago, the markets went up very strongly, but 7 stocks went up and everything else was even or down. There were tremendous tax loss harvesting opportunities there, would reap clients or have reaped our clients' benefits in future years.
Because at some point, for most clients, they are going to have to tap into their portfolios. They're going to have to sell their Apple or Microsoft or whatever stock at some point just to pay the bills. So if we can lessen the impact of the tax situation, we think that's a good thing. How about Roth conversions?
When you do a Roth conversion, you owe a tax bill. I look at when you do that during a 10% downturn or whatever, that reduces the effect of your tax bill.
So let's talk about that. So we had $1 million portfolio that you were going to convert, and so if you convert it, today you convert it and you pay tax on $1 million. But let's say tomorrow there's some negative market event and your portfolio goes from $100,000 down to $900,000. And you say, geez, Paul, I'm glad we waited. Let's convert it today. Well, now I have the tax bill on only $900,000, not $1 million.
So the tax you pay is down 10%. But what happens when 900 goes back to $1 million? It's in a tax-free environment, not a tax-deferred environment.
Huge benefit.
All your money, not money that you share with the government.
And we often talk to our clients about, hey, if the market declines, if we see a big market decline for X or Y or Z, and you say, hey, you know what, Paul, I think it's time to convert. No problem with giving us a call. And I remember during COVID, our clients, they kept calling and saying, you told me to call it. Not that we weren't on top of them already, but they kind of beat us to the punch, which I thought was pretty refreshing.
It's a great time to revisit the plan that's already in place, solidifying the confidence that they have in their portfolio.
Mm-hmm. And a third plan is just rebalancing. So what is rebalancing? We'll give you a simple example. You have $1 million and you have $500,000 in stock and you have $500,000 in bonds, let's say. And we go through a recession and the markets go down significantly. And now your $500,000 of stock is worth $400,000 and your bonds, we'll say, are worth $500,000. Well, we're not at a 50-50 split. So we would sell $50,000 of the bonds and we would buy $50,000 of stock. And now we're at $450 and $450. Historically speaking, the markets have gone back up. And then, so now your $450 is $550 and your bonds are still $500. Well, then we would be selling $25,000 of stock to get us back.
How I simply verbalize that to clients, it's a sell high, buy low, fine tuning, tune up to your portfolio. And we like to automate it because if we did it emotionally, it doesn't make as much sense. But when it's automated, you're selling high, you're buying low.
And it's usually additive to the portfolio, usually lowers the risk a little bit, increases the rate of return. Sure. So let's talk about some protocols that you could put in. Pre-crash protection, and that is preparing for sequence of return risk. And if you are nearing retirement or at retirement, that we've got a block of, we call it cash, a block of very low volatility investments that are interest bearing that we can tap into, that the value isn't going to change. Yeah. We don't have to focus on the day-to-day fluctuations.
Another way of saying, and this is how I practice the strategy, is if we can figure out how much income you're likely to need or how many assets that you're going to need to supplement your income over the first 10 years of retirement. If we put that amount of money in a really safe place, Market volatility does not put at risk our first 10 years of income, the point in your retirement life where you're most susceptible to sequence of return risk. So clients have great confidence when they know that some protocol like that is in place.
Next one is tax loss harvesting acceleration. So there are specific strategies that can be employed for tax loss harvesting. We think those make sense because they're, again, unemotional, and there is a group of people that are overseeing your account with a specific goal of, A, managing the money for growth, but B, trying to take advantage of tax loss harvesting. And in any given day, let's think about this. There's things that are going up and there are things going down. I mean, you could take a wonderful day on Wall Street and the markets are all up. There's always something that's down. And it might be something that's out of favor. It might be, Hershey stock and cocoa prices go through the roof. What happens to Hershey stock? It may go down. I mean, that doesn't make it a bad company, and maybe cocoa prices are temporary, but you might see a decline in the market and they would do a tax loss harvest, sell something, and then repurchase it later. Roth conversions we talked about. Again, we've mentioned a number of times, we think taxes are on sale. Roth conversions are a great thing to do in down markets. And again, it's all about how do I try to do this? Now, the most important part of this is if you are on the Roth conversion bandwagon and you're doing annual Roth conversions, we don't have to do them January 2nd. We could do them May 2nd or July 2nd or November 2nd or December 2nd. So I think being patient, or even structuring them throughout the year. Maybe you do one a quarter.
Yeah, you basically reverse dollar cost average your Roth conversions.
Right. But again, having a plan is more important than not having a plan. Rebalancing. Studies have varied widely about rebalancing and how much it can add to the portfolio. But again, we think we can increase rate of return a little bit. We think we can lower risk a little bit. And again, when we're talking about millions of dollars, every 100% or what we call a basis point matters. So we're always cognizant. We're not afraid of picking up a quarter if we see it laying on the street. In fact, I saw a penny the other day and I said, I need to pick that up because if I don't, I will have forgotten where I come from. So we're not afraid of doing that. I want to go back to sequence of return risk because we think it's so important. We have things called bucketing strategies where we have certain blocks of money prepared at certain points in your retirement lifetime, especially the first 5 years. And again, starting to prepare for that 5 years before you retire, we think is really, really important. I'll use an extreme example. I remember in 2009, March, early in the year, even December of 2008, I remember hearing people talk about their 529 plans for their kids. Hey, I've got to pay tuition in January and my account's getting killed. It's down 25 or 30%. Well, who made up that shortfall? Mom or dad or student loans. But if we had that money that was earmarked, it's one of the few monies you ever needed at exactly predetermined fall semester, spring semester time. But if you didn't prepare for it, it could have been pretty painful. And there was no way to make up for it other than to do it somewhere else. It was real out-of-pocket money.
I think it's underrated how important it is to protect the assets within 5 years of retirement from sequence of return risk. If you retired at the end of 2021, markets were high, portfolios were high. If you waited till the next year or you were designed to retire in 2022, markets were down 20% by Labor Day. Mm-hmm. So your portfolio shrank, and now you're thinking, can I afford to retire? All kinds of negative things can happen when you're not prepared for that.
And those people that we dealt with at that period of time, if you had that bucketing, we had them in bucketed strategies, and it really you still have the emotional scars of your portfolio going from $1 million down to, pick a number, $850,000.
But the ability to have the conversation with those folks and say, look, markets are down, your accounts are down, but we have money set aside for 10 years. So the money that's in the market that's down, we don't need for 10 or 15 years. It doesn't make sense for us to make a move now. We have time to let it recover. And my client said, yeah, that makes a lot of sense. Let's let it recover. Let's not make emotional decisions here. And we've been blessed that that's worked out famously.
So what we try to talk to clients about, and this might sound silly, but when you're in the grocery store line and you hear people talking about how bad the markets are, or you're at a cocktail party and everybody's talking about the markets and how bad they are. And in 08, 09, it was fashionable for people to say, oh, I sold my stuff a month ago and I'm sitting all in cash. beware. And when you start to hear those conversations, maybe it piques your interest and you say, hey, maybe I should be rebalancing. Maybe I should be converting. Maybe I have money sitting on the sideline for investment that I should be putting in. You'd be surprised how many of our smarter clients take advantage of these down markets and add money or rebalance or do whatever it has to be to try to get it done. So assess your situation. Do you have 2 or 3 years of expenses, living expenses in stable assets? How about, have you ever documented your tax loss harvesting? Have you thought about Roth conversions first of all? And if so, what about the timing of them? How do you maximize the timing? It's not market timing. It's just if you get the opportunity, isn't it a good time to do things? Market crashes can be transferring of wealth from the unprepared to the prepared.
No.
And if you think about it, lots of smart money makes money in down markets, and lots of not so smart money loses it. You've worked too hard to let the market ruin you. We're going to have down markets. It's not like a homeowner's insurance that your house might burn down. We are going to have recessions in down markets. So why don't we prepare for those things that are going to come up for certain?
That's really important. You prepare for not if they're going to happen, they're going to happen, and you're prepared for when it does, and insulating your portfolio accordingly.
So investing is the easy part. It's a sequence of return risks that wealthy families obsess over.
The 5 years before and after retirement determine everything. Our next video reveals a retirement red zone, the protocol that protects your first decade. Click to watch now.